Craig Parker here from Parker's Property Sourcing, just coming at you with another video today. And in today's video, I really wanted to talk about a debate that constantly comes up regarding property investing. And it's one of the areas where investors get misled a lot, really early on in their early stages of investing. And that is obviously cash flow versus capital growth, and which one actually makes you wealthy in property. So most opinions you hear are based on partial experience. So people who have only invested in one type of market, for example, or one phase of the cycle. And also some investors focus purely on monthly income because it feels safe, and others obsess over growth because that's where usually in property, that's where the big numbers come from. So in today's video, I'm going to explain how wealth is actually built in property investing based on market behavior risks, risk management, and long-term survivability. Not hype or no shortcuts, just pure facts. Hope you enjoy. So, cash flow versus capital growth. Almost every investor reaches this crossroad when in property investing. The question usually comes up after the first purchase, when people start thinking about how can they scale. Because one thing I will say is what I know, and something that I felt, and lots of people around me feel the same. Once you get your first property, and then you get it rented out, or you flip it, or you do it, you do your first property deal, you really do get the bug for it. You never think, I'm never going through that again. It's always, you really do get the bug for it, So it's always, this question always comes up when you're starting to think about scaling your portfolio or your property business. Cash flow feels sensible and reassuring, and capital growth feels exciting and ambitious, usually. That's the two feelings that these two things give you, and I'm speaking from experience. But the problem is that most investors believe they must commit to one or the other. And in reality, the decision should change depending on where you are in your journey. Very, very important. So for me, when I first started, my first property that I bought, I was looking at that from a cash flow perspective, to be honest with you. And then capital growth just happened over time. But my first investment property, I was, trying to put money in to get that money working for me as hard as I can get it to work. So, it all depends on where you are in your journey as well, which is a very important point to note. So, what is cash flow? That's a good question to answer, I would say, because cash flow is not rent minus mortgage. And this is a common mistake a lot of people make. True and real cash flow is what remains after every cost of that deal is accounted for. So it could be the finance, the maintenance, the compliance, the insurance, the voids, the management, the tax. Once all of that's minus off, what that number you're left with is your actual cash flow. So if you wouldn't be comfortable living with that number every month, it's not strong enough cash flow. So again, it goes back to, your individual circumstance. My number could be, £350, £400 a month cash flow after everything. Your number might have to be 600. So our strategies might be different, but we have to make sure that we understand what cash flow actually is. So just to reaffirm, it isn't, mortgage rent minus mortgage payments, because there's so much more involved in that, and we've got to make sure we take that all out of it as well to know our actual cash flow. Consistent and positive cash flow gives you control, and it also removes pressure from decision making as well. So, positive, good cash flow is really, really good. And just going back off that, most investors exit the property not by choice. A lot of investors exit the property deals because of pressure. It's very important. The pressure could be rising interest rates. It could be unexpected repairs. It could be personal income changes. And all of these things really do force the sell, or want you to force the investors to want to get out of the deal, and usually at the wrong time. So cash flow acts as a buffer. It buys you time, and it gives you more options, and it makes you feel a bit more comfortable. Do you know what I mean? So if you've got a nice big buffer of cash flow sitting there, and the interest rates tweak a bit or change a bit because these things happen, if it doesn't affect your cash flow that much and you're still making a good chunk, you won't feel the squeeze as if someone was right to the wire with their monthly cash flow after all of their outgoings have come out, and then their interest rate goes up. They might be screwed, you know? So I would say time is what allows strategies to work. Without cash flow, even good assets can become a bad investment. So, when we're investing in property, cash flow is so important. So important. So let's talk about capital growth. And I've put here equals value increase over time. Capital growth is where net worth is built, yeah? But it operates in a completely different timeline. So we're now not talking about monthly cash flow. We're now talking about capital growth. This is driven by population growth, supply constraints, wage growth, inflation, and obviously demand. Yeah, this is nothing to do with your personal effort. This is just what's going on around you. It's very, very uneven. It comes in cycles, and it doesn't come in straight lines. Capital growth does not come in straight lines. And then, growth is realized through refinancing the property or selling the property. And it doesn't improve day-to-day affordability on the deal. Yeah? So that's something to bear in mind. If you're buying a property with only capital growth in mind, and you haven't taken into consideration the monthly cash flow, the monthly constraints, you might get yourself into a bit of a situation as well. So capital growth is great. Capital growth is very important, but this is something that happens over time. So I've put here, growth without cash flow is speculation. So true. When investors accept, say, a negative cash flow deal, they're really betting keyword betting on the future market conditions. This can work in strong rising markets, but as somebody that's experienced now and that's been investing for 10 years, the market doesn't always cooperate. If rates rise or rent stagnate, the numbers can quickly become unsustainable. It can quickly go from left to right very, very quick, So at that point, the strategy relies on luck and timing and not fundamentals. So I would strongly stay away from buying a house or buying a property just based on capital growth in 20 years' time, and not looking at, what could be happening throughout those 20 years, So cash flow wins when rates rise, markets stall, and when life happens. Very, very true. Cash flow becomes very essential during stress scenarios. Markets pause, lending tightens, and refinancing options sometimes disappear. And at the same time, personal circumstances change unexpectedly. All of these things happen, you know. All of these things can happen to anybody. Um, Banks can assess income, not unreleased equity. Yeah. So that's something to really think about. If you're looking to refinance or borrow more money, and the bank asks us to have a look at your portfolio, it's very important they ask for, you know, what you're making. So what rent are you receiving, and what your mortgage is. They don't ask how much equity have you got in that property, you know, which means cash flow directly affects borrowing power. You know, cash is king, is the saying. And again, I'm not shooting down capital growth, because capital growth wins when you can hold long term, and when demand is strong, value is forced. Yeah. So again, capital growth over long term is very good, and it can make you a lot more money than what you probably be making on a monthly basis through your cash flow. So I'm not saying, you know, capital growth isn't important, but growth performs best when investors are under no pressure at all. And as I've said in this video many a times now, cash flow relieves the pressure. Forced appreciation through refurbishment or planning can definitely accelerate results on your capital growth as well. Long-term holding allows compounding and inflation to do all of the heavy lifting. Yeah, so it's very important. Again, if you're looking to invest and you want to invest strictly just on capital growth, I would say you need to make sure that you're holding for a very long time. So you have to be taking into consideration monthly cash flow, you know. None of this works if the property cannot support itself financially, is what I'm saying. So capital growth is great and it can make you very wealthy, but it doesn't work if that property is not giving you monthly cash flow, giving you a bit of meat every month. So it's not either or, it's all about timing. The mistake is framing this as a permanent identity. Yeah? So early investors need resilience and margin for error. And this will always come from your monthly cash flow. Later stage investors can use growth strategically because their downside risks are a lot lower. The best investors really do evolve their strategy as their portfolio matures. I started investing 8-9 years ago, and you know, my strategy then, and even up to 2-3 years ago, my strategy then was cash flow. You know, buying a high demand area with good capital growth history, but I'm all about cash flow, my return on my investment. Am I making 15% of the money that I've put in? Am I clearing 15% return on my investment of the money that I put in? If I'm not interested in the deal. You know, so that's been my strategy. 9 years down the line now, and I'm looking at the portfolio that I've got, and I'm starting to look at putting equity out to reinvest. I'm now realizing the capital growth, but at the time, it was all about cash flow at the beginning, you know. So it's all about timing. So cash flow gives you options to hold, to refinance, or just to wait. It reduces stress, dependency on market timing, overthinking. It reduces all of that, you know. So cash flow equals freedom. Capital growth, on the other hand, increases your net worth and leverage capacity. So used together, they create sustainable and scalable portfolios. A lot of investors underestimate how important early stability is. You know, cash flow builds confidence, it helps with borrowing power, as we touched on earlier, and resilience to what's happening in the market. And once the foundation is solid, growth compounds quietly in the background. Yeah? So this approach really does reduce risks while still capturing the upside of things, you know? So look, wealth comes from balance, doesn't come from extremes. You know, I'm an advocate of slow and steady wins the race. And what I mean by that is that over the last 8, 9 years, I've been slowly building my portfolio, investing properly, getting good cash flow. I've now looked back and thought, actually, I've got a little bit or quite a bit of equity in all of these properties that I've bought. So I can see my wealth building in the background, and it's been a very balanced approach. So I would say, you know, a lot of people are in property and they are trying to or are making money and getting rich quick. It's just not my approach, you know. I'm trying to build that long-term wealth. So extreme strategies work only in perfect conditions, I would say, and balanced strategies survive imperfect ones. So understanding when to prioritize protection versus expansion is what definitely will separate the long-term investors like myself from the short-term speculators, which I see come and go all the time in this property game. So we've come to the end of the video. Thank you so much for listening. If it's helped you clarify how property wealth is really built, make sure you subscribe for more grounded, experience-led insights. I've been Craig Parker as always, and I'll see you again next time.